All right. I am going to do it this way. 1 second here. All right. Perfect. All right. Welcome, everyone. My name is Kim Snider, and tonight I am going to make the case for Bitcoin in your retirement account and why that's not crazy, as many conventional investment folks would have you believe. In fact, I believe that it's very, very sane. Now, for those of you who don't know me, I spent 20 plus, almost 30 years now as a successful wealth manager, author, speaker, educator, financial radio talk show host, and industry disruptor. I retired in 2009 to live here on my farm in Aiken, South Carolina, play polo, and live happily ever after. At least that's what I thought. And all was going perfectly according to plan until one day, what is it? It's been not quite 2 years ago. Knowing that I had been in the investment business, a very good friend of mine here mentioned to me that she had inherited $300,000 worth of cryptocurrency. And this was a big deal for her. She's in her early 60s, maybe late 50s, but I'm pretty sure it's early 60s. If I had to guess, probably earns about $100,000 a year. And she confided in me that they had been pretty far behind on their retirement savings. So now it's just her income and her savings. And she asked if I had any opinion on what she should do with all of this cryptocurrency. Now, at the time, I knew absolutely nothing about Bitcoin or cryptocurrency. My husband, Jim, is our family CFO. I had been out of the business for a pretty long time at that point, years. I hadn't kept up or even thought about investing. And yet, you know what my knee-jerk reaction was? It was, oh my God, sell that. Now, I knew nothing about it. Nothing. Barely knew what Bitcoin even was. But my lizard brain heard that and says, alien, not my tribe, not mainstream, must be bad, right? There could be a saber-toothed tiger behind that rustling bush, run! Now, fortunately for me, I didn't say that out loud. And I kind of just forgot all about it until a few months later, she brought it up again. And now it was worth about $600,000. Well, that kind of got my attention. And she told me that, she was having to learn about all the exchanges that you buy and sell it on. She really had not done any investing prior, so it was really confusing. She really didn't have a strategy. And so, what was happening was her husband had been a really early adopter of Bitcoin, like way back. And so he was what was known as a hodler. HODL being a crypto acronym for hold on for dear life, if you're not familiar with it. And hodlers believe that you should never sell, ever. It's almost an insult, like you're a non-believer. They'll throw you out of the cult. So my friend was just hodling, which, as it turned out, was working out pretty well. Because at one point, she casually mentions to me that it's now worth over $1.2 million. Now, of course, that was the top in January 2018. And to my knowledge, she never took any of that money off the table, and she still has it. Well, along the way, like many people, I got interested. So I started to study it. First, really, all I was trying to do was to determine if it was real or if it was a scam, so that I could at least, properly have an opinion on that when she and I talked. And then as I realized that, whoa, like, this is definitely not a scam, this is really interesting, I started to, understand the nuts and bolts of what these different assets were and how you bought and sold them. And then how do you value them and how they might fit into an overall portfolio like mine and Jim's or hers. And so what I ended up doing was, over time, eventually creating a fairly simple system for investing our money that I think makes a lot more sense than what other people are doing. And then one day my friend says to me, you know what, I do not get this. Every time we talk, all you can do is talk about how unhelpful and misleading and probably illegal and scammy all the information on the internet is about cryptocurrency. And then this is what you do. So, why wouldn't you help people? And I thought, you know what? That is a great question. I don't know. I'd been out of the business so long. I didn't think of it. But in the moment she said it, I was like, you know what? You are absolutely right. I'm in. And so that's how Sane Crypto was born. So let me tell you what we are going to cover tonight. What I am going to do is I'm going to switch, hang on. I'm going to switch back to the slide deck. I want to make sure I don't hit the wrong button here. Slide deck. Oops. Here we go. All right. And, I'm going to do it like this. Excuse me. Perfect. Okay. So just so you're aware, tonight's program should last about an hour and a half, depending on how many questions that we get. It is also being recorded, so barring any technical glitches, if you have to leave early, which I hope you won't, but there will be a recording. And I'm going to show you, first of all, what do you need to know to understand sane crypto investing? Number two, what are the opportunities and the risks in investing in cryptocurrencies? And this is key, y'all. Understand, profit is the reward for risk. There are always both. This is not magic internet money, which is one of the things that I used to constantly complain to my friend about. She's like, come on, there's always both, okay? And then the third thing is then, okay, how do I manage those risks? I'm going to show you the system that I use for investing in crypto assets. And I will take just a few minutes at the end to tell you about my Sane Crypto Mastermind for those who want the diversification benefits and return potential of cryptocurrency, plus the guiding hand of a former investment advisor with a 20+ year proven track record, namely me. So let's dive in. To understand why I think Bitcoin is not only a good investment, but an essential investment, you have to understand how I think about investing. My starting premise is that you have to invest. Everyone does. Even those with lots of money, because if your money isn't growing by at least the rate of inflation each year, you are losing purchasing power. Now, I am not saying that you have to invest in Bitcoin, although you probably should. I am saying that you have to invest. There was an article last week. It was titled Post-Crisis, because last week was the 10-year anniversary of the financial crisis, or of Lehman imploding, which kind of marked the real turning point in the financial crisis. And it said, post-crisis, wary investors miss out on huge returns, right? No, that was the headline. And it said, only 10% of total respondents invest more today than they did 10 years ago, compared with 66% who said they invest less. Like, that makes me so crazy. It makes me want to cry, actually, or shake people, shake some sense into them, or both, because it's completely irrational. It's the opposite of sane. Your job as an investor is to take the money that you create from your intellectual and physical capital, meaning your work, and transform it into enough financial capital that you can live 30 or 40 years in retirement without having to make decisions like, do I give my spouse the very best health care I can, or risk running out of money myself? And that example is not a hypothetical. Both of my grandmothers were in long-term care. My one grandmother was diagnosed with Alzheimer's. She lived for almost 20 years. At the time that she was diagnosed, she had an estate that would seem to be more than enough, a couple $1 million. By the time she died, she was literally in danger of running out of money. She had run through that entire estate. Now, can you only imagine? Fortunately, and I mean this in not the way it's going to sound, but fortunately, my grandfather had preceded her, because can you even imagine being him and having to be the one to say, either my wife, my soulmate, gets the absolute best medical care that she deserves, right? In her illness, but if I give her that, I will be left with virtually nothing in my old age, or I have to skimp on her in order that I have enough. Like, that is an awful, awful choice. Fortunately, he didn't have to make that choice. But those sorts of choices, or even choices like, do I take my medicine or do I eat today? Like, those choices are very real in retirement. Okay, so not hypothetical. This is deadly serious stuff. So mathematically, to replace a $150,000 a year income and have a reasonable probability of living comfortably for just 30 years in retirement, okay, will require a nest egg of at least $1.9 million, just as an example. And to do that is going to require, in addition to saving a meaningful portion of your earnings over time, a low double-digit return on your savings. Now, I'm not saying all the time, okay, because that's not realistic. Some years the returns are negative, some years they are positive, but over time, over your lifetime, you need to average at least a low double-digit return. And unfortunately, the average 20-year return of the stock market has historically been around 8%, plus or minus. And the later that you start, the less compounding you're going to get, so the higher that average return will have to be to make up for it. So we're going to have to find some higher return somewhere, okay? That's the second premise. You have to invest. You're going to need double digits, and so we're going to have to find some higher return somewhere, okay? And you need to be good at it, this investing game, right? Because this, I said this investing game, but it's not a game. As I said, the consequences are enormous. But in spite of what many people think or would have you believe, okay, investing is really hard. And here's why. One, unless you have a crystal ball, which to my knowledge hasn't been invented yet, the future is a probability distribution rather than some fixed outcome that's knowable or predictable in advance. So you are playing a probability game. 2, you are playing that game with a lizard brain, which happens to be hardwired over millions of years of evolution to be very bad at probability games. 3, investing is a zero-sum game, which means if you win 500, someone else has to lose 500. And you are playing that game against some of the brightest minds in the world, literally with unlimited resources for the ultimate prize, which is money. And then finally, as if that wasn't hard enough, the playing field is designed to disorient, distract, and deceive you. The financial press, and nowadays social media, is filled with propaganda and misinformation that act like the lights, the bells, and the buzzers on the casino floor. It's all a great system designed to part you from your money. Now, lest you think that it is an impossible game, it's not. It is not. That's important, okay? You see, investing is hard, not because it's rocket science or that only an expert can do it, but because we are humans. In fact, Morgan Housel, in a really great article I recommend to everyone called The Psychology of Money, gave a perfect example. If you'll permit me, I'm going to read here for just a second. He says, Grace Groner was orphaned at age 12. She never married, she never had kids, she never drove a car. She lived most of her life alone in a one-bedroom house and worked her whole career as a secretary. She was, by all accounts, a lovely lady, but she lived a humble and quiet life. That made the $7 million she left to charity after her death in 2010 at age 100 all the more confusing. People who knew her asked, where did Grace get all that money? But there was no secret. There was no inheritance. Grace took humble savings from a meager salary and enjoyed 80 years of hands-off compounding in the stock market. That was it. Weeks after Grace died, an unrelated investing story hit the news. Richard Fiscone, former vice chairman of Merrill Lynch's Latin America division, declared personal bankruptcy, fighting off foreclosure on 2 homes, one of which was nearly 20,000 square feet and had a $66,000 a month mortgage. Fiscone was the opposite of Grace Groner. Educated at Harvard and University of Chicago, he became so successful in the investment industry that he retired in his 40s to, quote, pursue personal and charitable interests. But heavy borrowing and illiquid investments did him in. The same year Grace Groner left a veritable fortune to charity, Richard stood before a bankruptcy judge and declared, I've been devastated by the financial crisis. The only source of liquidity is whatever my wife is able to sell in terms of personal furnishings. The purpose of these stories is not to say that you should be like Grace and avoid being like Richard. It's to point out that there is no other field where these stories are even possible. In what other field does someone with no education, no relevant experience, no resources, and no connections vastly outperform someone with the best education, the most relevant experiences, the best resources, and the best connections? There will never be a story of a Grace Groner performing heart surgery better than a Harvard-trained cardiologist, or building a faster chip than Apple's engineers. Unthinkable. But these stories happen in investing. That's because investing is not the study of finance, it's the study of how people behave with money. So, how does Bitcoin and cryptocurrency fit in? Well, remember I said that we're going to need to find some higher return somewhere? Well, that's one way. But the other less obvious benefit of investing in Bitcoin is that it reduces your risk in 2 meaningful ways, which is totally antithetical to what most people believe. But you know what? Actually, I'm getting way ahead of myself. So you know what? Because based on the survey answers that you all gave me when you signed up for the training, we have a lot of people at differing levels of knowledge about what Bitcoin even is. So actually, let's start at the beginning so that we're all on the same page. And then I will come back to these 3 points about risk and return. Okay? Okay. The best way to understand cryptocurrencies from an investment perspective is this. Internet is to blockchain as email is to Bitcoin. Meaning, internet was this obscure technology that no one really understood or knew what to do with in the mid-1990s, beyond like maybe a few nerdy computer scientists, until AOL started mailing out millions of CDs by snail mail. And suddenly email became the killer app that opened the floodgates to widespread mainstream adoption of the internet. Do y'all remember this?
You've got mail.
It's so quaint now, right? Well, today, blockchain is the new, obscure, potentially disruptive technology. And Bitcoin is the compelling use case that is starting to drive widespread mass adoption today. Now, whether Bitcoin eventually becomes as ubiquitous as email remains to be seen, but it's really important to understand that this is still early days for blockchain and Bitcoin, okay? So think early to mid-1990s. And the question is, if someone had created an investment in 1993 that you could buy and sell on an exchange, just like a stock, that allowed you to bet directly on the future success as measured by the widespread adoption and use of email specifically and the internet more generally, knowing what you know today, would you take that bet? Well, with the benefit of 2020 hindsight, of course you would, right? That would be amazing. You'd be a gazillionaire. Now, of course, we don't have the benefit of 2020 hindsight on Bitcoin and blockchain yet, but there is an investment called Bitcoin that you buy and sell on an exchange similar to a stock that allows you to bet on the future success as measured by widespread adoption and use of digital currency specifically and blockchain more generally. And the question is, knowing what we know now, should you take that bet? That's the question that we're trying to answer tonight. So let's dig a little bit deeper into blockchain and Bitcoin. What is blockchain? Blockchain is the technology underlying all cryptocurrencies. Blockchain is software, just like the internet is software. And just as the internet protocols like HTTP and FTP and TCP/IP gave us the ability to transfer data, i.e. files, music, videos, images, etc., around the globe in the blink of an eye, peer-to-peer, meaning person-to-person without relying on a trusted intermediary like FedEx or the post office, blockchain gives us the ability to transfer value anywhere around the globe in the blink of an eye, peer-to-peer, without relying on a trusted intermediary such as a bank or a government. It's the internet of money. Now, where does Bitcoin fit in? Well, just as email is software that uses the internet to send data person to person, Bitcoin is software that uses the blockchain to send payments person to person. But this is where people get confused. Because of some of the choices in terminology that the inventors used, before they had any idea what Bitcoin would actually become, terms like digital cash and cryptocurrency, both of which turned out to be very unfortunate misnomers, people assume that the use case for Bitcoin is buying pizza in Starbucks, and it's not. Other cryptocurrencies may eventually solve for that, but those won't be good investments any more than the US dollar is a good investment, because the whole point of the payment rail is that it is stable, right? You wouldn't want to hold it if it was changing in value, therefore not a very good investment, because we hope that those go up in value, right? The way to think of Bitcoin from an investment perspective, which is all I care about, is as a store of value. In other words, as a better gold than gold, meaning an ideal store of value will be durable, portable, fungible, verifiable, divisible, scarce, have an established history, and be censorship resistant. So this chart that's up on your screen summarizes these characteristics for Bitcoin, gold, and fiat currencies. Now, in case you are not familiar with the term fiat, Robert Kiyosaki says gold is God's money, fiat is government money, and cryptocurrency is the people's money. So fiat is things like the US dollar or the British pound, government issued money. And unfortunately, I don't have time to spend on all of these, but let me just touch on a couple very quickly. For example, in order to be a better gold than gold, something must be easy to transport and store. Bitcoins are the most portable store of value ever used by man. Private cryptographic keys, which you can think of as like passwords on steroids, which could represent $1 or hundreds of millions of dollars, can be stored on a tiny USB drive. This isn't one, but basically, something this size, and put in your pocket and easily carried anywhere. Literally, you could walk across an international border with millions of dollars in your pocket, or in your head if you could remember that passphrase. Furthermore, equally large sums can be transmitted between people on opposite ends of the earth almost instantly, without any intermediary like a bank or central government, which is why Robert calls it the people's money. It also has to be divisible, meaning it has to be easy to subdivide. One of the common objections that I hear about investing in Bitcoin is that the price is too high. Over the last year or so, Bitcoin's price has been anywhere from a few $1,000s per Bitcoin to $20,000 per Bitcoin, and everywhere in between. And it is not uncommon for someone to see that sort of price and think Bitcoin's totally out of their price range, like my investors used to say about, Berkshire Hathaway or something. Well, very few people, especially those used to investing in stocks, realize that Bitcoin can be divided down to 100 millionth of a Bitcoin, 8 decimal places. So I can buy literally $10 worth of Bitcoin if I want, and I can send or transfer $10 of Bitcoin, right, as well. Just like I could send $10 million of Bitcoin. That's what we mean by divisible. The one attribute that most clearly distinguishes Bitcoin from fiat currencies and gold is its predetermined scarcity. What we mean by that is that by design, at most, 21 million Bitcoins can ever be created, ever. That's all there ever will be. And this is going to be key, as you're going to see a little bit later on in this presentation. Censorship resistant means how difficult is it for an external party like a government or a corporation to prevent the owner from keeping and using it. censorship resistance might not be that big of a deal for those of us here in the US, although there was a very long period of time where the government made owning gold here in the United States illegal. It wasn't until I think like the 80s when we could own gold again, but censorship resistance is a really big deal if you live in parts of South America or Africa, the Middle East or China. When Bitcoins are sent on the Bitcoin network, transmitted over the network, there is no human intervention who decides whether that transaction should be allowed, okay? It's a distributed peer-to-peer network. Bitcoin is, by its very nature, designed to be censorship resistant. So this is the most compelling use case for Bitcoin. As a store of value, not as digital cash, but digital gold. And this is also the bet that it will succeed in supplanting gold in whole or in part as the preferred store of value going forward. And someone said to me the other day, hey, I'm like, you'd have to be crazy to buy Bitcoin. And I get that, I do. Because coming from a traditional investment paradigm without understanding the play, that's what I initially thought too, as I told you in the beginning. But we're not talking about investing in a stock here. This asset can't be valued using standard discounted cash flow analysis or demand for use in the production of higher order goods like a commodity. And its price movements and price potential are on a totally different scale than stocks. The Bitcoin fall into this entirely different category of goods, which are known as monetary goods. And you can see that relative to other markets, cryptocurrency is just this little teeny tiny guppy at a total market value of about 200 billion right now. If you look, the world's 50 richest people have a total net worth combined of approximately $1.9 trillion with a T. And then on the right-hand side, if you look, the market cap of the global stock markets is like 73 trillion. Okay, so yeah, little teeny tiny guppy right now. But let's take a look at gold down on the bottom. And let's just imagine a couple of scenarios, keeping in mind that there is ever only going to be 21 million Bitcoin in the whole world, okay? So let's just imagine best case that Bitcoin is successful and literally does become the dominant payment system in use throughout the world. I mean, it could happen. Look at Amazon, right? Like they're about to become their own country soon. It's a stretch, admittedly, right? But okay, let's just play along. Current estimates of the total worldwide household wealth range anywhere from 100 trillion to 300 trillion dollars US. So with 20 million coins, that gives us a coin, each coin a value of about $10 million per Bitcoin. Or, okay, let's ratchet that down. Let's just say if it only competes with gold, that's it, as a non-sovereign store of value. Well, if we take the market cap of the existing above ground gold supply, so we're talking about just like it replaces gold, which is approximately $8 trillion to a maximum Bitcoin supply of 21 million coins. Okay, that gives us a value of about $380,000 per Bitcoin. Or we can even ratchet down a little bit further. Let's just say that it became a non-sovereign store of value used only by investors. Okay, well, Bitcoin's still really early in its adoption curve there. Institutional investors aren't even in the game yet. It's been largely retail up to this point. So if we assume broader participation from retail, because right now it's only about 3%, and then, especially institutional investors, you get to a price level between like 100 to 200,000 per Bitcoin, totally feasible. Now, I know that sounds crazy. But it is possible. I every time I say it, that's why I laugh, right? Like, I mean, those numbers just sound ridiculous. But it is possible, not certain, but well within the realm of possibility. Because again, here's what I want you to think, right? Imagine if someone had allowed you to buy stock, not in AOL or Cisco or Level 3, but in the internet back in 1993. And instead of this chart, we're looking at being financial, we were looking at email, right? Which would have been a little bitty teeny tiny guppy as compared to the market for FedEx, UPS, DHL, snail mail, faxes, and phone calls over landlines. Well, what might the value of that investment be now, 25 years later, right? Well, if the value was based on the network traffic and adoption of the internet, it's incalculable. It would have seemed equally crazy at the time. So let's just say that you accept my investment premise of a better gold than gold. In fact, you think it's really exciting. Do you back up the truck and buy as much Bitcoin as you can? Absolutely not. Okay. All right. Let's take a look at how I think Bitcoin fits in the big picture. So in my world, I take a waterfall approach to portfolio design, meaning I think of each asset class as having a job. And that part isn't necessarily that unusual, but what most financial advisors will do is they will just take 100% of your investable assets and divvy up the money amongst the different jobs, amongst all the different asset classes, all at once. It's like that proverbial pie chart. And I don't do it that way. One of my favorite books, and one that I highly recommend, is called The One Thing by Gary Keller, co-founder of Keller Williams Realty, if you haven't read it. And The One Thing offers this clarifying question that I find useful on an almost daily basis. And that clarifying question is, what is the one thing that if I did it right now would make everything else easier or unnecessary? So what is the one thing that my portfolio must do? The one job it must accomplish that would make everything else easier and unnecessary. I figure out what that is and I allocate all the money to that job until I get that accomplished. And then, and only then, do I begin allocating investable assets to the next asset class to fulfill the next job. So in my case, the answer, its highest purpose, the one thing that my portfolio must do for me, if I could only pick one, is to provide financial freedom. And I define financial freedom as the ability to do what I want, when I want, without having to worry about how I'm going to pay for it. And the assets that I'm going to invest in order to accomplish that are what are called cash flow assets. Then, once I've accumulated enough cash flow assets, then and only then do I move on to the next job. And the next thing in my world is protecting against hyperinflation. And the asset class that we typically invest in order to protect against inflation, specifically hyperinflation, is commodities, things like metals, meats, grains, energies, etc. And that is because in an inflationary environment, commodities, hard assets, go up in price. That's the definition of inflation. So then, once I have enough of my portfolio to where I feel like I have that covered, then and only then do I then begin to invest in what are known as non-correlated assets in order to address market risk, which is the thing that most people do first. Now, non-correlated means that mathematically they don't go up and down together. They tend to go up and down over time because all investments do, but they go up separate from one another, up and down separate from one another. So hopefully if you have enough of them in any given year, some are up and some are down. And an example of a non-correlated asset would be real estate, for example. So this is the idea of modern portfolio theory and a diversified portfolio and why we own different things. But for me, that's job number 3. And I typically don't start investing in a non-correlated asset class until I have the first 2 taken care of. So if that's my world, where do crypto assets fit? And it's funny because crypto kind of upended my worldview that I'd had, nice and neat for 20 plus years, right? So I'll tell you how it fits. Crypto assets are not cash flow assets, so it's really no benefit in that regard. But interestingly, we have quite a lot of anecdotal evidence from countries like Argentina, Zimbabwe, Turkey, Greece, and Venezuela that the price of Bitcoin does go up in periods of hyperinflation, as we would expect, it being a digital commodity, a digital gold, just like we would expect gold to. So it does help us hedge against inflation and financial crisis. And it is also a non-correlated asset. Correlation is a mathematical equation, and it's measured on a scale of 1 to -1, with 1 being highly correlated, meaning the assets go up and down together, 0 being uncorrelated, and -1 being negatively correlated, meaning that they will tend to move opposite to one another. The 3-year correlation of the S&P 500 to the NASDAQ, for example, is 0.95, meaning, as you would expect, they are very, very correlated. The 3-year correlation of Bitcoin to the S&P 500, NASDAQ, gold, and Brent crude is -0.01, -0.02, 0.05, and 0.01 respectively, meaning it is uncorrelated with all of them and therefore provides mathematical diversification to the portfolio. Seth Klarman says the 3 best ways to reduce risk are diversification, hedging, and buying with a margin of safety. So we'll get to the buying with a margin of safety in a minute, but for now, Bitcoin checks both the diversification and hedging boxes for us. A second benefit is diversification of your money, which is different than the portfolio diversification benefit we just discussed. If I had drawn this correctly originally, really the waterfall should look like this. Meaning before you even begin investing, the very first priority is to create an emergency fund of at least 6 months of expenses, preferably 12 months. And I am not an alarmist by any stretch of the imagination. In fact, I generally think of myself really as an optimist. But I do have hope for the best and plan for the worst as a core financial philosophy. And in keeping with that, I believe that you should also have some money outside of the banking system where it's accessible in the event the shit were to ever really hit the fan, just as a matter of prudence. So to me, it only makes sense that that money should be diversified as well by holding some in native currency, which for me is US dollars, some in cryptocurrency, which for me is Bitcoin, and some in physical gold. So a second benefit is diversification of your money. The third risk pickup, which is the one that you probably have heard me talk about the most is the outsized return potential. Quoting Charlie Munger, he says, risk to us, which, by the way, if you don't know who Charlie Munger is, he's Warren Buffett's partner in Berkshire Hathaway. So when he says risk to us, he means he and Warren Buffett. He says risk to us is 1, the risk of permanent loss of capital, or 2, the risk of inadequate return. The historical rates of return of Bitcoin, right? I mean, I know these numbers, but every time I look at them, it's really staggering. They've been 1,395% in 2011, 200% in 2012, 5,525% in 2013, then minus 59% in 2014, 36% in 2015, 124% in 2016, and 1,307% in 2017. In 2018, year to date, we're down something like 60%. Now, is that volatile? Yes. But note, Charlie Munger said permanent losses of capital, not temporary losses of capital. And that is the hardest thing for a lizard brain to grasp. And inadequate returns are a massive risk, massive, for reasons we discussed in the beginning, far bigger than the risk of losing the money, so long as you don't let your lizard brain invest too much. So in my world, it's not part of the waterfall. It's something that we do right away. We peel off 2% of our investable assets of whatever we are doing, wherever we are, and we put that into crypto assets. And the reason we're buying it now is it is this potentially once in a lifetime opportunity with a massively compelling upside downside skew. An asymmetric upside is another way of putting it, that diversifies and hedges our portfolio as well as our money. So we don't wait, it doesn't go into the waterfall. Assuming that it is suitable, which is something we'll talk about in a minute, it is something that we peel off right now and do. Now, this is all with the understanding that it could happen that the very moment you buy it, it heads straight south and never ever recovers, right? Most of what you hear or read about crypto assets, I'm just going to tell you, is absolutely complete and worthless garbage, okay? On both sides, bull or bear. But there are a few sane voices in the space, like serious thinkers and academics, and to be very clear, they do not agree on the future of cryptocurrency. Some make a reasoned or maybe even, vociferous argument for Bitcoin at $1 million each, and others make an equally vociferous argument for Bitcoin at $1 each. And the thing is, nobody knows. We never know, right? Only time will tell who is right. But in the meantime, understand that somewhere between $1 million and one are probably a lot of other scenarios, including it taking a really, really long time to play out with lots of ups and downs. So you have to understand that this is a long-term play, which is why a small amount of risk capital that you can afford to write off is absolutely key, okay? So now we know how it fits into our retirement portfolio strategically. We can begin to look at it tactically. And let's start with some scenarios and who it is a suitable investment for and who it isn't. Let's start with Jack. Jack is retired. He has a $500,000 portfolio, and that portfolio is producing just enough income for him to live on with absolutely no room for error, meaning that if he lost any of it, or even if it sat dead for a period of years, meaning dead, meaning, you know, it was down in value, it was not producing cash flow for him to live off of, would meaningfully impact his standard of living. So in his case, this is not a suitable investment for Jack, okay? The key is that you cannot invest money that you can't afford to lose, or you can't afford to sit dead, right? Because as I said, it's a long-term investment, no matter how compelling that upside skew might be, all right? Now, on the other hand, let's take a look at Jill. Jill is 62 years old, lives in a suburb of Des Moines, Iowa. She's divorced, has 2 children and a grandson, Zach, who she adores spending time with. She is still working as a school administrator. She's not started taking Social Security yet. She has a $500,000 portfolio, which is spread over her 403B, an IRA, and a taxable account. She holds stocks, bonds, REITs, and commodities, all in low-cost index funds, and she would love to retire in 5 to 7 years. But she's not sure whether she's going to be able to, because while she's on track, she'd have to cut back a little bit to live off of her retirement income. And she is also a little bit concerned about the cost of healthcare if she gives up her benefits from her job. So let's take a look at the math for Jill. Again, the way that I think of an investment portfolio is in terms of the sustainable cash flow that it can generate. Since for me, that is job number 1 for a portfolio. So just to use a very simple rule of thumb, which I'm not crazy about, but people are familiar with it and it makes it simple. Given a 4% withdrawal rate in retirement, the current cash flow potential of Jill's portfolio is $20,000 per year. Okay, this is in addition to Social Security, which she plans to start taking at 70. The assumption, based on my rule from earlier, is that Jill would only invest up to 2% of her investable assets, which in her case, that would be $500,000 times 2% or $10,000. So let's consider worst case. Jill invests $10,000 in crypto assets and she loses it all. The income potential from her portfolio has fallen from $20,000 per year to $19,600. Not ideal, but also not catastrophic. But on the flip side, let's not look at her Bitcoin going to $1 million or 500,000 or even 100,000 per Bitcoin. Although again, there are valuation models under which that's not far-fetched. Let's just take the returns of 2017, which are just over 1,300%. So they happened last year. No guarantee that they'll happen this year or ever again, but just to try to show just a reasonable upside scenario. Last year, her gain on that $10,000 investment would have been $124,478. That is what we mean by a ridiculously favorable upside-downside skew. If you are completely wrong, you lose the entire $10,000. Your retirement income potential drops by $400. But if you are right and you just get last year's returns, your portfolio income is now $25,000. That's a 25% raise for life. And oh, by the way, break even is the opportunity cost of the investment you moved it out of. So chances are, I think, anything above a 6 to 8% return over time is going to be a win. I said to Larry the other day, it's a little bit of a moonshot, but with the potential to push you into orbit if it works and not hurt anything too badly if it doesn't. But that assumes it is a suitable investment and you don't screw it up by getting greedy and ruining it by investing too much. I think each of you should have copies of the Sane Crypto Retirement Calculator and the emails that I sent you prior to this training. If you don't, you can get it by going to the website and clicking the link at the top that says free tools. So get out that retirement calculator and do this math for yourself to see what both the upside and the downside would look like for you. If losing 2% of your portfolio would meaningfully affect your future security and standard of living, don't do it. It is not for you. If it wouldn't, to pass up the potential upside with the benefits of diversification just isn't sane. And one last thing, by the way, if you'd like to discuss the retirement calculator and the results, feel free to schedule a call with me. I'm happy to do that. You can schedule at sanecrypto.com/schedule. You'll find a link there where we can find a time that works for both of us. All right, does that make sense? Okay. If it does, then with your permission, I'd like to take a quick minute to tell you about my Sane Crypto Mastermind. If you heard my interview on my podcast with Dr. Meyer Statman, one of the fathers of behavioral economics, he said, good advisors are more managers of investors than investments. And I couldn't agree with that more, which is why the goal of the mastermind is to, one, give you the confidence to make an investment in crypto assets if it's appropriate for you, knowing that you don't have to figure this all out on your own through trial and error, which is the investment piece. In fact, one of our members was kind enough to leave us a review on Facebook recently, and I noticed that it spoke to exactly that, which must mean I'm getting it right. Michael said, the knowledge was invaluable, well worth the money. I could have never researched all this myself and felt confident about what I was doing. Plus the lessons in cybersecurity were invaluable. Thanks for all your help. And two, probably more importantly, the goal is to help you make more money and keep more money than doing it on your own, which is the investor piece. And we achieve both of those by having a system. This is mine. I know it's like a little visually overwhelming. To some of you who invested with me in the past, this will all be really familiar to you because it's everything that I've ever said or taught about investing, just applied to cryptocurrency. The point of a system, and I think Dr. Statman and I talked about this as well, the point of a system is to tell your lizard brain what to do in every possible scenario so that you don't screw it up. And by every possible scenario, what I mean by that is that it leaves absolutely no room for guessing, no room for improvising or interpretation. There's never a place where you say to yourself, gee, I wonder what I'm supposed to do here. The answer is always clinical and clear cut. We put your lizard brain in a nice, cozy little box, and we don't let it out no matter how loud it screams at us. And oh, by the way, all of these systems, whether it be my earlier system or this one, it's for me first and foremost. Everything that I teach is the way that I invest my own money. All were developed for me primarily, and because I have just as big of a lizard brain as everybody else. And what I figured out was that I needed to keep my lizard brain in a box, and the way to do that was through systems. And it just so happens then that I share those systems because they work really well with other people. So what that looks like in the mastermind is that I've created a detailed video library that covers the what, the when, the where, the how, and the why of every single step in the system. Nothing left to the imagination. It is a step-by-step, hold your hand, push this button, fill in this field, download this file sort of recipe. and you get instant access to that video library the moment that you join. You also get unlimited updates to that, because as I said, the system is the way that I invest my money as well. Someone asked me, well, does it change that much? Oh my gosh, you have no idea. I mean, the system changes somewhat as new tools and exchanges and even in the future derivatives and other things become available to us. Then the system will evolve. But even without that, just the changes, keeping up with a brand new nascent space, those change all the time. So yeah, so unlimited updates are really important. That means that you you pay once, and I keep updating the system for myself, and you get access to all those changes for as long as I'm doing it. You also get unlimited phone and email support from me. What I originally was thinking was that I would do like a Facebook group, but what my beta users told me was that they didn't want a Facebook group, which made total sense to me, because if you're in the middle of something, you want an answer, reasonably quickly. So we scrapped the whole Facebook group idea and just went with phone and email support. So I'm your customer service rep for now. We also do an archive of support questions. Every time someone sends me a question, I do a couple things with it. Not every question, but almost all of them. One, I add it to the bottom of the relevant video. In the notes section, each one does have notes as well. And but I also have created like almost like a blog, a reverse chronological order of all the questions that I get asked. And that it's searchable and all on a single page, so that someone can say, they don't have to say, oh, what video, I know someone asked this, I have this question, I know someone's already asked this question, what video was that on again? No, you just go to that one page. Actually, you can, oops, see it on the left-hand side where it says FAQs, that's the page. People really like that. You also get weekly member emails as needed, meaning when, I'm not going to clog your inbox up just for the sake of it. When there's something important that I need to tell you, then I send you an email. Again, people preferred that over a Facebook group or something like that. And then you also have my cell number, and that's because I'm only a single person, so the email and phone support is really for business hours. I'm East Coast in the US, kind of 8 to 5-ish. But if you are in the middle of something and, it's not my normal business hours and you really need help and it's urgent, then, you should, I'm going to help you. So that's what my cell phone number is for. And then finally, there is a no hoops, no hassle 6-month guarantee, which gives people the opportunity to try it. And it's interesting because, there's really a couple of scenarios here. One is that you know nothing about cryptocurrency investing and you're a little nervous about, or maybe you're not, super, you're a little bit technology challenged or, whatever. So, and so you think, well, what if I can't do this? So, that guarantee takes the risk away. Or what if you're already investing in cryptocurrency and you think to yourself, I don't know if I'm going to get value from this? That guarantee takes that risk away. Or maybe you're neither of those things. You're right down the middle and it's probably a perfect fit for you, but for just whatever reason, you get in and you say, no, not for me, right? No worries. You just let me know. I'm not going to take your money if it's not for you for whatever reason. So within 6 months, you let me know, we're still friends, and I will refund you 100% of the tuition. JT is one of those people who already knew something and was investing in cryptocurrency prior to joining the mastermind. He says, hey, Kim, I've been watching your videos and listening to your podcasts. I think they're wonderful. I enjoy them all, and I truly appreciate both your philosophy and opinions and the practical and helpful nature of the masterclass. I think he meant mastermind instructional videos. I had no idea how much I had no idea about. And it feels so good to have you walk through the steps and show how it all works. Thank you for that, JT. So this is a newish program at this point. I started it for real probably in like February of this. Yeah, well, yeah, I'd say I've got about 65, 70 people in it now. And so what I'm doing still, I still consider it in beta. So because of that, I'm offering $100 off the initial rack rate. The rack rate is $1,497, and that discount is really in exchange for being an early adopter and understanding that I am, because of the, as I told you before, the how rapidly things change. I am really focused on content, not bells and whistles, like, you know, fancy membership sites and stuff. But as hard as I try, you know, a video might not always exactly match the spreadsheet because, you know, things, UIs and things are changing so fast. I mean, I do keep them up to date, but you know, like that's what I mean by being an early adopter. Also, that discount encourages you to move fast, which is really for your own good, because over time I've been ratcheting down that discount and ratcheting up the price, which I will continue to do. So in order to get that discount for the first 10 people, you can use a promo code IMAVIP, and don't forget to hit that apply button, because if you don't, then it doesn't apply the discount. Once the 10 people have signed up, then that discount is no longer available. It'll just, actually, I think it'll say no longer available. Okay, so with that, that is it about the mastermind. I went a little longer than I thought, but we're still in good shape. So I am going to go to Q&A and see what questions you guys have. Get a sip of water here for a second. Okay. Okay. Tom says, being a longtime investor in your other investment strategy, I am very, oh, hey, Tom. I am very comfortable with the inherent risk and reward component of that strategy. My question is, how do the risk reward component of this compare to that? Well, okay. So first of all, hang on. So let me just back up for a second and explain for those people who don't know what Tom's talking about. I actually kind of alluded to this tangentially in various places, because I saw some of you guys are in here. I created a cash flow investment called the Snider method for myself 30 years ago, and started teaching it to friends, and then friends of friends, and friends of friends and friends, and then that grew into an investment firm with $500 million under management. And we taught that method to over, I think it's probably now over 10,000 people, something like that, over the years. And even though I retired in 2009 and later sold the firm, including anything to do with the method, they got all of that. They bought all of that. Some of my prior clients found me when I came out of retirement and started to get into cryptocurrency. And so Tom is one of those. And and I'm honored that that they are still following me these many years later. So anyway, that's what he's referring to. I have nothing to do with the Snider method, but that's what he's talking about. Okay, so but by the way, I shouldn't say this, but when we talk about the cash flow portion of that waterfall, that's what it is. Okay, so so with that as background, you know, the high level principles, Tom, are going to be the same, right? As I said, everything I've ever said about investing applied to cryptocurrency. You know, things like, you know, pigs get fat and hogs get slaughtered, and create an investment so that we're okay no matter what happens, and like, you know, all those high level first principles are the same. That said, the risks, well, the objectives and the risks are just totally different. Where that is a cash flow investment designed to produce a relatively steady cash flow from, you know, paper assets, from stocks. You know, this is about that asymmetric upside potential. It's the fact that we are basically getting the opportunity to participate in what looks very much like a venture capital investment, like the guys who get, you know, to be early seed investors in Uber and Airbnb and Facebook, but we get to participate. Along with that, though, comes the idea that, you know, the certainty is much less. You know, you don't get that kind of asymmetric upside, you know, without there being a very real chance that it won't materialize. And so you have to structure that investment accordingly. So, you know, even though I really believe that Bitcoin specifically is much less risk than people think, you know, you still have to assume that you're going to lose that money, right? Which is not an assumption we plan for with the other, but it is just definitely not an assumption that we make on the Snider method, right? So, so the risks and objectives are very different, you know. But again, as I say, you know, with this, you know, not all risks are created equal. As you know, volatility is something that in the Snider method we profit from. You know, people fear in cryptocurrency. You know, a lot of people will say, "Oh, I'm not going to invest in this because it's too volatile, it's too risky." And, you know, I don't see this volatility as a risk at all. In fact, to some extent, you know, it's a benefit because it washes out the weak hands and things like that. But anyway, so not all risks are created equal, but it is very definitely a very definite, completely definite, different risk reward profile from what we were doing previously. Hopefully that answers your question. Okay. Dean says, my question is, what are the steps to actually placing the order and buying Bitcoin? What platform would you recommend, and any other details to cover? Great. This is covered in, as I said, extensive detail within the mastermind, in the videos. Talks about the different exchanges and which ones you pick and why, and, you know, how to open them and all those things. But very broadly, just to answer your question, the steps initially look, if you're a stock investor, are going to look very, and I also did a podcast on this too, so you can go back and listen to that if you want. But so the steps broadly are, one, you're going to open an account with an exchange, okay, which is going to be different than the the brokerage accounts that you have in order to, you know, buy and sell stocks within your IRA or taxable accounts. So you can't do this in your Schwab or your TD Ameritrade account. You have to, for now at least, go to these exchanges that specialize in cryptocurrency. You are going to open an account. You're going to verify your identity, very similar to what you would do with a Schwab or TD Ameritrade account, because of our U.S. KYC, which is Know Your Customer, and AML, anti-money laundering laws. They have to know who you are. And, you know, with whatever, driver's license and stuff. So you verify your identity, then you connect your bank account, and then you're, again, similar, and then you are going to transfer money, however much you're going to invest from the bank account to the exchange, right? Again, just like you would do for stocks. Then once the money is over on the cryptocurrency exchange, then you're going to place an order to buy each one order for each thing that you're going to buy. So again, in the stock world, if you're familiar with that, you might place an order to buy 100 shares of IBM. Here you're going to, place an order to buy whatever, 10 Ethereum or 10 Litecoin or, half a Bitcoin or whatever that is. And then you'll see once the order is placed on the exchange and filled, you'll see it listed in your positions. The money will be deducted and the asset will be added. And up until that point, it looks very, very similar to what you would be used to on a traditional stock exchange. Where it gets different is with the stock exchange, you would just leave the stock there until you're ready to sell it. You would never ask for the stock certificates. However, in the cryptocurrency, we do not do that. This is really, really, really important. You do not want to leave your crypto assets on the exchange. Your keys, your money, not your keys, not your money. If that's hacked, it's gone. There's no insurance or things that like you've got with the traditional brokerage firm. So what you're going to do is you're going to buy what's known as a hardware wallet. This isn't one, but I kind of held this up and said you could walk across a border with this. You're going to buy something like a Ledger Nano. You're going to transfer that money to your hardware wallet, which basically acts like your safe or your own bank. You are your own bank, and moves that money off of the exchange until you're ready to sell it. And in which case, you're just going to reverse that entire process and move it back to the exchange, place the sell orders, then you'll have cash, move that back to your bank account, and you're done. So that is how that is done. Trish says, why would I want to buy cryptocurrency when all they have done is go down? Shouldn't I wait until they go back up again? Trish, this is exactly why you need the mastermind to put your lizard brain in a box. That is a really, really, really common sentiment, and it is absolutely backward. So the first thing that you have to know is that all markets go down. There's no such thing as an investment which only goes up. The other thing you should know is that bear markets and volatility are a gift. And the reason I say that is if you look at any of the investors who made their fortunes in investing as opposed to made their fortunes somewhere else and brought them to the markets, and the number of people who have done that are very few and far between. People like Sir John Templeton, Warren Buffett, etc., right? The Big Short guys. To a man, the way that they make those fortunes is they have an almost uncanny ability to buy when everyone else is selling and sell when everyone else is buying. Whether you're talking about John Templeton buying into Hong Kong before it switched over to China when everybody else was selling, or Warren Buffett buying banks after the financial crisis, or the Big Short guys actually going the other direction. It's buying when everyone else is selling and selling when everyone else is buying, which by definition means, right, if you wait until everything is going up, that is not the way to make money. Yes, it feels better, but it is not the way to make money. Now, and in fact, let me just show you something. Bear with me for just a second. I didn't intend to use it for this, but I have it, so I'm going to show it to you. See this chart? Note, I didn't even talk about this, Trish, but the green is the return of the S&P 500 in each one of these years. And the red is the return, and the S&P 500 is the major index of stocks in the United States. The red is the return of the average stock investor in the United States in that same year. On every single year, this is the results are from the Dalbar study, the quantitative analysis of investor behavior, which has been done for over 30 years. Investors underperform their investment by a massive amount. And the reason for these numbers is very specifically because our lizard brains cause us to buy tops and sell bottoms, because we want to buy when it's going up and sell when it's going down, because greed or fear of missing out causes us to want to buy as it goes up, and fear, right, of losing money. It doesn't feel good when we're watching our accounts go down, and so we sell. And so the trick to the whole thing, and the whole point of having a system, it is to design it so that it, in a very strategic way, thoughtful, proven way, forces you basically to do the opposite, which is to buy when things are going down and sell when things are going up, which is what my system does, and all successful systems and investors do. So, so the answer is no, you definitely should not wait until, until it goes back up again. That is the recipe for losing money, right? Underperforming the investment, not outperforming. Okay. Okay, hang on. I got myself all worked up. I need one more drink. Hang on. Okay. Jim says, since it sounds like you don't like the buy and hold philosophy in your mastermind program, do you invest in Bitcoin by buying and selling based on a formula to take emotion out of the investing? Yes, no, and yes. Actually, I am a believer. So what I'm struggling over is this idea that I don't like buy and hold. What I do, what I believe in all of my systems, as I just said, is to not sell when the price is dropping, because that's volatility, washes those weak hands out, right? What we have to do is buy when the price is selling, or at least hold, and sell as it's going up. So it's not that, and so, if the flip side of that is, if this is a long-term play, I will buy and hold for a really long time, until it goes up. No guarantee that it will. So, that's why I'm trying to be a little bit, specific about that. This could be a long buy and hold, but if it's going up, yeah, then we're going to sell on the way up. Now, that said, the other part is true, that we do absolutely positively do the buying and selling based on a formula to take the emotion out. That's the key to the whole thing. And it's what, made the Snider method work. It's what makes this work. If you don't have that, you're flying by the seat of your pants, and you're not gonna have a good result. So yeah, that's absolutely positively critical. So hopefully that clarified a little bit. Okay, what else? All right. All right. Well, if you guys don't have anything else, we'll call it a wrap for the night. Again, I really, really appreciate you being here. This has been super fun for me. I love doing this. I think I said in the beginning, if you'd asked me a year and a half ago if I'd ever get back into the investing game, I'd have told you it's just not going to happen. But cryptocurrency is special. And this has been really fun for me to re-engage my brain on something that is a new asset class in many ways. Like I tell people all the time, it's a new and exciting asset class. But all the old rules of investing still apply, and yet it's something that we've never seen before. It's an opportunity that just everyday investors like you and I have never gotten the chance to take advantage of, and it's really really fun to share it with people that I know and and hopefully trust me to guide them in this. So if you're one of those people and you want to come along and as part of the mastermind group, you're welcome. We would absolutely love to have you. If I can answer any questions for you at all, mastermind or no, you know where to find me. My contact information is all over the website. It's Kim, and my email is kim@sanecrypto.com. Give me a call, schedule some time. And again, just a reminder, it's $100 off for the first 10 people, and that code is IMAVIP, all one word. I'll talk to you guys later, and thanks for being here. Good night, y'all. Hey, Jim, hang on. Let me just, I see your question. Hang on.